Let's start with a story you might find very familiar. Imagine a young person, we'll call her Maya. Maya has just received a bonus from her part-time job, a crisp $1,000. Her mind immediately starts racing with possibilities. The first thought is exciting and immediate, the brand new smartphone she has been eyeing. It has a better camera, a faster processor, and all her friends are talking about it. Buying it would bring instant joy and satisfaction. She can picture herself unboxing it, setting it up, showing it off. This choice represents spending money right now for an immediate benefit. It's a tangible reward for her hard work, something she can hold and use every single day. But then, a second thought creeps in, a more cautious one. Her old phone still works perfectly fine, even if it's not the latest model. What if she put that $1,000 into a high-yield savings account? It wouldn't be as thrilling as a new gadget, but the money would be safe and easily accessible. She could use it for an unexpected emergency, like a car repair. Sudden trip. This option offers security and peace of mind. The money would be liquid, meaning she could get to it quickly if she needed to. It's the responsible choice, the one that prepares her for the unpredictable turns that life can sometimes take, providing a safety net. A third, more ambitious idea then takes root. What if she invested that $1,000? She has heard her friends talking about investing in the stock market, or even in a friend's small business idea. This path is filled with uncertainty. The money could grow significantly over time, potentially turning into much more than the original $1,000. It could become the seed money for a down payment on a house, help fund her future education. However, it could also lose value if the investment doesn't perform well. Maya is now standing at a crossroads, facing a classic financial puzzle. Should she choose the immediate pleasure of the new phone, or the security of having cash ready in a savings account? Or should she take a chance on the long-term growth potential of an investment? Each path offers a different benefit, but she can't have them all at once. To choose one, she must give up the others. This very situation, this act of choosing between competing options, is the foundation of all financial decision-making. Maya's dilemma perfectly illustrates a core concept in finance and economics: the trade-off. A trade-off is simply the act of giving up one thing you want in order to get something else you want more. You can't be in two places at once, and similarly, a single dollar can't be spent on a new phone and saved for the future at the same time. Every financial choice we make involves weighing the pros and cons of different options and deciding which outcome is most important to us at that moment. Think about it in simpler, everyday terms. If you decide to spend your Saturday afternoon studying for an important exam, you are trading off the fun of hanging out with your friends. The benefit you hope to gain is a better grade. If you choose to eat a healthy salad for lunch, you might be trading off the immediate satisfaction of a greasy burger for the long-term benefit of better health. Life is full of these decisions. In finance, the stakes are measured in money, but the principle remains exactly the same. We are always giving up something to gain something else in return. Understanding this concept is the first step toward making smarter money choices. In the world of finance, there are three fundamental trade-offs that appear again and again. They are risk versus return, liquidity versus return, present consumption versus future consumption. The first major trade-off is perhaps the most famous one in all of finance: risk versus return. Let's define these terms simply. Return is the money you gain from an investment. If you invest $100 and it becomes $110, your return is $10. Risk is the chance that you might not get the return you expect, or worse, that you might lose some or all of your original money. The core principle connecting these two ideas is that, generally speaking, if you want the chance to earn a higher return, you must be willing to accept a higher level of risk. There is no such thing as a free lunch in finance. Let's look at a spectrum of options to make this clear. At the lowest end of the risk scale is holding physical cash, or keeping your money in a government-insured savings account. The risk here is almost zero. You are practically guaranteed not to lose your initial amount. However, the return is also very low. Your money might earn a tiny bit of interest, but it will likely grow very, very slowly, sometimes not even keeping pace with inflation. It's the financial equivalent of staying on the ground floor of a building. You are completely safe, but you don't have much of a view. Moving up the scale, we find options like government or corporate bonds. Here you are lending your money to a government or a company. The risk is still relatively low, but slightly higher than cash, as there's a small chance the issuer could fail to pay you back. In exchange for this slightly increased risk, you receive a higher return in the form of regular interest payments. Next come stocks, which represent ownership in a company. The risk here is much higher. The company could do poorly, and the value of your stock could go down. However, if the company does well, your potential for return is also much, much higher. At the very top of the risk and return ladder, we find things like investing in a brand new startup or speculative assets like some cryptocurrencies. These are the riskiest of all. Many startups fail, and many speculative assets can lose their value overnight. You could easily lose your entire investment. But for that immense risk, you get the chance for an astronomical return. An early investment in a company that becomes a global success could multiply your initial money hundreds or even thousands of times over. This is the trade-off in action. To get a shot at the biggest rewards, you must be willing to take the biggest chances. Our second fundamental trade-off is liquidity versus return. Liquidity is a simple but powerful idea. How quickly and easily can you convert an asset back into cash without losing a significant amount of its value? Think of it as the spendability of your money. The cash in your wallet is perfectly liquid. You can use it instantly to buy a cup of coffee or a bus ticket. There's no waiting period and no penalty. This ease of access is extremely valuable, but it comes at a cost, often a lower return. Let's create another spectrum, this time for liquidity. At the most liquid end is physical cash and money in your checking or savings account. You can withdraw it from an ATM or use a debit card in seconds. Because this money is so readily available, it earns very little, if any, return. The bank isn't giving you a high interest rate because you can pull your money out at any moment. You are paying for convenience with a lower potential for growth. Moving toward the less liquid side, we have assets like stocks and bonds. On most days, you can sell your stocks or bonds and have cash within a few business days. This process is fast, but not instant. Because your money is slightly less accessible, and you're taking on market risk, you generally expect a higher potential return compared to a savings account. You've given up a tiny bit of immediate access for a step up in potential earnings. At the far end of the spectrum are highly illiquid assets. The classic example is real estate, owning a house or an apartment building. You can't turn your house into cash this afternoon. Selling a property can take months, sometimes even years. It involves finding a buyer, negotiating a price, and navigating a complex legal process. Because your money is tied up and hard to access, you expect a much higher potential return. This is also true for investments in private businesses and fine art. The rule is clear. The harder it is to get your cash out, the higher the return you should demand. The third and final trade-off is one that feels very personal and psychological. Present consumption versus future consumption. This is the choice between enjoying your money today and saving or investing it so you can enjoy even more in the future. Present consumption is spending your money right now buying that new phone, like Maya going out for a nice dinner, taking a vacation. The benefit is instant, tangible, and feels good right away. It satisfies our immediate wants and needs. Future consumption is delaying gratification, foregoing spending today and putting that money aside. By saving and investing, you choose more purchasing power in the future. Why would you have more? Because of the magic of compounding. You invest your money and it can earn a return. That return starts earning its own return. The process snowballs over time. A small amount saved today can grow into a much larger sum years from now. Let's consider two simple scenarios with that same $1,000. In scenario A, or present consumption, you spend the $1,000 on a weekend trip. You have a wonderful time, create great memories, and come back with no money left. In scenario B, or future consumption, you invest the $1,000 in a fund that earns an average return of 7% per year. In 10 years, through the power of compounding, that $1,000 could grow to nearly $2,000. In 20 years, it could be close to $4,000. You traded the immediate fun of a trip for the ability to do something much bigger later on. This trade-off is a constant battle between our present self and our future self. Our present self often wants instant gratification, driven by emotion and the desire for immediate pleasure. Our future self, however, would benefit from patience and discipline. Finding the right balance between enjoying your life now and providing for your future is one of the most important financial skills you can ever develop. Now that we've explored these three key trade-offs, let's visualize them with the financial triangle. Imagine a triangle with three corners, each one a core concept. Top, return, growth. Bottom left, safety, low risk. Bottom right, liquidity, access. The key idea, you usually can't have all three. Typically you pick two, or balance somewhere in the middle. Let's place some examples onto this triangle to see how it works. Very safe and very liquid, like a savings account. This sits along the bottom edge of the triangle. You have safety and liquidity, but you give up return. Secure and accessible, but it won't grow much. Ideal for an emergency fund. High return and high liquidity, like actively traded stocks. You can sell relatively quickly, but you sacrifice safety. The stock market can be volatile. Values go down as well as up. This is common for investors who tolerate fluctuations and think long-term. High return and relatively safe, like investing in a rental property in a stable market. You gain return and safety but lose liquidity. Real estate is illiquid. Your money is tied up and can't be accessed quickly. This model shows every financial product is a compromise. By seeing where a choice sits on the triangle, you understand what you're gaining and what you're giving up. We have journeyed through the three fundamental trade-offs that govern the world of finance: risk versus return, liquidity versus return, present versus future consumption. These are not abstract theories. They're daily choices. Buying a new phone. Planning for our retirement decades from now. Invisible forces shaping our financial well-being. The financial triangle is your mental map, a visual compass. You can't have maximum safety, maximum growth, maximum access all at once. Every choice is a balance. There's no single right answer. The best choice depends on you, your circumstances, your goals, your comfort level. Young person starting a career, willing to take risk for higher returns. Nearing retirement. Prioritize safety and preservation. Saving for a house in 2 years, need liquidity and safety. Turn this knowledge inward. Use it as a compass for your financial journey. Think about your habits and tendencies. Which trade-offs challenge you most? Do you always play it safe, missing growth, or take big chances without a safety net? Is liquidity your issue? Too much cash idle? Or the present versus future struggle? Choosing immediate satisfaction over future goals? Wherever you are, aim for awareness, not perfection. Understanding trade-offs lets you make deliberate, empowered money decisions.